Hello again. This is the first example of the accounting equation. Alright, let's start right off. Paula decided to start her own company. She had $10,000 of cash, $5,000 of equipment, $1,000 worth of supplies, and she invested all of this into her company called Paula's Place. She decided to take out a loan of $15,000 to buy some land and a loan of $10,000 to buy a building. She also made her first sale of $4,000, which the client promised to pay next month. Alright, when I'm looking at an accounting equation video, I decide to always look at assets first. So what does Paula have that's an asset? Well, we know that assets are cash, equipment, supplies, land, buildings, and accounts receivable. And it looks like she has all of these things. She has $10,000 of cash, $5,000 of equipment, $1,000 worth of supplies, a $15,000 land investment, a $10,000 building investment, and she has an accounts receivable of $4,000. Now, before we move on, some of you are probably thinking, I thought a loan would be an account payable because she has to pay back the loan. She has to pay the bank what she borrowed. But she used the money that she borrowed to buy land, and also took out a second loan to buy a building. That is why we're counting this as part of the asset account. Now I want to differentiate this here real quick. She still has to pay the money back, so there's still going to be an account payable that she has to pay. But remember, the accounting equation has to be balanced. So if it appears on one side of the equation, it also has to appear on the other side of the equation, but in a different form. So if we look here, she made her first sale also of $4,000, and the client promised to pay that next month. So that is an accounts receivable. So after adding all these together, we get a total of $45,000 in total assets. The next part of the accounting equation is liabilities. So what liabilities does she have? She has a loan of $15,000 here and a loan of $10,000. And that's going to be a total of $25,000 in liabilities. So if you remember in my previous video, we decided that equities was really assets minus liabilities. So if you want to figure out what equities are actually supposed to be before we move on, you can actually do that. But I'm not going to do that one in this video. I think that's kind of superflutive. So remember, what is equities? It's common stock, dividends, revenues, and expenses, and also retained earnings. But since Paula just started her company, she will not have any retained earnings in the business. If we read over the paragraph one more time, we can see that Paula does have a revenue of $4,000, but she doesn't have any expenses, and she also didn't pay herself any dividends. But what is interesting to note is that she invested more than just cash. She invested cash, equipment, and supplies. And that is possible. A lot of people actually do that. Like, some people come in with a building that they want to use for their business. Some people come in with, say, several large trucks, or they come in with something that's more than just cash. But that doesn't mean that we're not going to count it as part of common stock. And as you can see here, the total value of $10,000 plus $5,000 plus $1,000 is $16,000 worth of common stock. She also had $4,000 worth of revenue. And as you can see, that's a total of $20,000 worth of total owner's equity. Now, thank you all very much for watching. Please leave a like and watch my next video. Thank you very much.